My name is Stuart Weems and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And welcome to my first podcast episode of 2025. Hope you had an awesome break over the Christmas New Year period, and special thanks to Campbell Wallace for filling in for me the last 3 Wednesdays. He discussed some really interesting topics and we've received some great feedback from those podcast episodes, and I hope you really enjoyed them. I think he did a fantastic job, especially considering that it's his first time doing a podcast. So thanks so much for all your support. I will invite him to do some podcasts throughout the year. He's got some really good topics that he wants to talk about, and it'd be great to, share the microphone with him and have you listen to a different voice every now and again. Of course, I need to apologise. I somehow managed to get some sort of cold flu or something. I'm getting over it, but my voice might sound a little bit more nasally than it usually does, so I apologise for that. So every year, James Kirby and I do an episode on the property market, our expectations for the next year. We always do that in January, of course. And I recorded that episode with him last week on the 9th of January on the Money Puzzle podcast, which is the Australians Finance podcast. It's always a heavily listened to episode. I guess we all want to know what might happen in the coming 12 months if somehow we had some sort of crystal ball. And of course, it's really difficult to predict what any market will do, or really anything will do over the next 12 months. A lot easier to pick longer term trends, but it makes for kind of interesting listening, and particularly, for long-term investors that, have a buy and hold strategy, it's not that important. In fact, I would say it's not important at all what might happen over the next 12 months. But for those that are considering getting into the market, acquiring another property, whether that's a home or investment property, or divesting of a property, what might transpire over 2025 actually is kind of important. So I wanted to record today's episode to really address the key points that I talked to James about, but also there's a whole bunch of, it's hard to get all the information into that sort of podcast. So I'd like to just share with you, my full thoughts on this matter. So before we start thinking about 2025, let's look at what happened in 2024, and I will use CoreLogic's data just because it's the most sort of current or up-to-date data, if you like, and it can take me right through to the end of December. So on a average 5 capital city basis, house prices rose, and I'm talking about house prices, not units or dwellings. And it's important to understand the difference. Dwellings will include unit and houses, and that's going to have a different set of data, of course. So we're just talking about houses here. On average, rose 5.2%. So not fantastic, but not terrible. And it's really a tale of kind of 2 markets, if you like. We've got Perth, Adelaide and Brisbane all had close to double-digit returns. Brisbane around 10%, Adelaide around 12.5%, and Perth 18.7%. That was the standout performer. Of course, Sydney and Melbourne underperformed. Melbourne fell by about 3%. Sydney rose about 2.5%, which is actually less than inflation. So in real terms, a decline there as well. It's worth noting that obviously Melbourne was the only market to decline. And, speaking to clients and other people in the property market, it is really obvious that in Victoria, and particularly in coastal locations, there are a lot more potential sellers than there are potential buyers. And whilst there's a lot of stock on the market in some of those locations, particularly again beachside locations, it's obvious certainly through conversations that there's far more people that would like to sell but have chosen not to sell in this market because they realise they'd have to drop their price too far. So actually, if there was more buyer demand, I think we would see even more transactions. And the thing that's kind of underpinned prices to some extent in those locations, I say to some extent, is that there's no forced selling going on. So if there were higher levels of financial distress and forced selling, I think we would see property prices, particularly in Melbourne and Victoria, but even in Sydney and other locations, I think we'll see property prices faring much worse. Now, I don't expect that to change, so I don't expect people to be in a financial position. I mean, some will, but as a whole, not enough to impact the market. So I think most people can afford to sort of sit tight, ride it out, and if they want to divest of that asset in the future, they can do so. But I guess the point there is that if we're looking at some of those coastal locations, there's a pent-up demand of vendors, if you like, and I think the vendor supply will always equal the demand from buyers. So we're probably not going to see much growth in those markets over the coming years, which is no surprise because we all know markets move in cycles. So in October last year, I published episode 324, and I talked about the factors that have the greatest influence on property prices. And I highlighted that interstate migration, loan volumes and housing supply are really the three most influential factors in the long term. Sentiment, of course, buy or home sentiment can have a much greater impact in the short term. But I think interstate migration, I'm going to talk about each of these because it'll frame sort of what our expectations or what my expectations might look like for 2025. I think interstate migration is a really good proxy for buyer sentiment or sentiment in regards to particular locations. And when sentiment is strong, and that means that demand for housing will increase, and typically then that follows that prices increase. So let's look at interstate migration. We have the data until mid last year, so June 2024. We get September data in around February, end of February, I think. So it'll be interesting to see what happens there. So it's something I keep a watch of, and who knows, I might write about it again. If we have a look at Sydney, Sydney is actually losing net. And I'm going to talk with all these figures. We've got people coming to a state and people leaving from a state. I always look at the net figures because that's the key part. When you look at Sydney, they tend to lose around 5,000 people per quarter. At the moment, they're averaging over the last 12 months, 7,700 per quarter, so 50% more. So really Sydney, for whatever reason, is lacking in sentiment. I mean, you probably can talk about affordability, cost of living, these sorts of things might be sort of driving that, particularly in a higher interest rate setting. But if we think that there's 2.5 people per dwelling, then the number of dwellings, I mean, there's other parts of the population, of course, you've got a natural increase. And of course, Sydney attracts a large share of overseas immigration too. So the population is still growing, but of course, this is a drag. Interstate migration is a drag on property in Sydney. In Victoria, we've seen a turnaround. So during the COVID period, so 2020 to 2023, Victoria lost about 5,000 people per quarter for obvious reasons, of course, during the lockdown. Thanks, Dan. The long-term average is a net loss of 1,000 people per quarter. And in fact, in the last 12 months, it's been a net inflow of 660 people per quarter. Now, the numbers here aren't really the key element, because you could say, okay, we've got 660 people, 2.5 people per dwelling. Okay, there's not a lot of additional dwellings needed. It's not really the point. It's not really about the numbers. It's really about a proxy for sentiment. And what that's telling us is perhaps sentiment around Melbourne and Victoria is changing. And the best evidence of that is Queensland. If you look at their net interstate migration, it's running about average 7,500 people per quarter. A long-term trend is 6,000, so that's 25% above trend. Certainly reflecting, and that's been like that since 2018, so we can certainly see that's reflecting in the prices. South Australia's net migration has always been negative, and it remains in the negative territory, but to a lesser extent. I think that's mainly due to sort of job opportunities and so forth. And Western Australia, after years of very below average interstate migration, they're positive about 2,500 people per quarter. So again, you can see that the data sort of lines up with property prices. So in summary, I think there's going to be a little bit of a drag. It looks like a little bit of a drag on Sydney. It looks like Victoria's sort of turned around, but there's still a lot of demand for those cheaper capital city markets in Queensland, South Australia and Perth, of course. So let's look at loan volumes, because that can have an impact on property prices. Obviously, the amount of money moving into the property market is considerable. We shouldn't ignore there's a lot of cash buyers out there. About a third, as I understand, of property buyers buy without a mortgage. So it's not true that everyone wants a mortgage or needs a mortgage, but certainly most people do. You look at loan volumes between 2020 and 2022, they increased significantly, huge. I mean, they reached an all-time peak. Of course, when interest rates were really low, borrowing was more affordable and more attractive, so that made sense. Borrowing volumes, I should say, started to come off around February 2022, and particularly after May 22, when the RBA started hiking interest rates. And so they sort of came back as you would expect. But since March 23, lending volumes have rebounded strongly and actually at the moment are close to almost the peaks that they reached in early 2022. So loan volume is already quite strong. It's not surprising when we look at the loan volume in each state that Victoria has seen a reduction in loan volume. And this is for investors, because I think it gives us a good sense of kind of sentiment. And this is what we're really talking about, is investing in property in this podcast. So it's not surprising that Victoria is seeing lower loan volumes, not by much, only about sort of 3 or so percent. So in context of the rhetoric that's been coming out of the state, it's not too bad. New South Wales up about 20% since pre-COVID levels. I'm sort of measuring this against, adjusting for inflation. And South Australia is up by about 50%, so it's no surprise. A lot of people investing in South Australia. And Queensland up over 80% since pre-COVID levels. I mean, Queensland's really bounced back. And Western Australia is up 235% in terms of loan volumes. Of course, that's coming off a very, very low base, so I wouldn't put too much into that figure. But of course, we know that that market is to some extent being driven by interstate investors. So looking back, and it should have been obvious to me at the beginning of last year, is that those cheaper markets we'll see more demand just because of lower borrowing capacity. Like if I went to the bank pre-COVID, maybe I could borrow $1 million. If I go to the bank today, that number's probably 800,000. So whilst I might have been thinking I'll buy a property in Melbourne, now I might be thinking, okay, well, maybe I should go to Queensland, for instance, although I think that thesis doesn't necessarily hold true today. But that's why I think a lot of those interstate markets have boomed through this high interest rate period. And I think affordability, loan affordability and borrowing capacity will really be the main factor that will sort of shape the market, if you like. So I think that will allow those markets to persist in terms of their growth, just because, I think more and more buyers are sort of priced out of those more expensive markets. But we have noticed that lenders have started relaxing some credit policies very, very much at the fringes, and a lot of changes aren't necessarily advertised as well, so they're sort of just doing it covertly. I think the banks will want to see credit growth continue, and I think they're quite comfortable that if interest rates are in decline, they're not too worried about rising defaults or arrears. And we're starting to see things like, the amount of documents you need to provide, some policies around interest only, renewals, these sorts of things are starting to be relaxed somewhat. So it'll be interesting to see what happens for the rest of this year, but I think that trend will occur. I don't think they will want to come out and aggressively change credit policy. It's clear that APRA, which is the banking regulator, doesn't want to change the 3% loan buffer. And so I think the banks will do what they need to do in order to keep that credit growth flowing. And I think most of that credit growth will flow into South Australia, Queensland and Western Australia and sort of repeat what happened in 2024. Now, the last thing I wanted to talk about was housing supply. There's nothing really any sort of governments can do really to change housing supply too much. There's been a lot of talk about sort of changing density in established suburbs, and that'll be up to state governments and councils to do that. Whether they'll be successful is a completely other question. I just don't think it's going to change overnight. But one thing we do have to navigate this year is a federal election, of course, and housing affordability and housing supply are always a hot topic in any federal election. I don't think that's going to be any different this time round. I know the Labor Party has said that they're not interested in changing capital gains or negative gearing, so that will help. Shorten many years ago talked about changing that, and that sort of did upset the market, the property market a little bit, like people didn't want to do or undertake any transactions until they worked out the lay of the land, if you like. It appears the coalition is interested in allowing first home buyers to access super to help with their first home purchase. And so that would be positive for the property market, of course, particularly the lower end, particularly, investment grade apartments, for instance, from a growth perspective. But I just don't think the federal election will have that much influence on the property market this year. So, of course, let's talk about interest rates, because that's always on the tip of everyone's tongue. And, it's widely expected, of course, the RBA will cut interest rates at some point during 2025. Most people are predicting around mid-25, that is May, sort of June, around that sort of period. Money markets have priced in 0.25%, quarter of percent cuts. So that's a 0.75% reduction over the course of this year. That's what the market's pricing in. The market's not really pricing any other cuts. Now, if we look at what impact that'll have on borrowing capacity, I estimate everyone's situation is different in terms of their numbers, but I estimate that that'll increase borrowing capacity by about 5 to 10%. So it will have an impact, and it might be, that extra 10% might be enough to sort of push you into being able to buy versus not be able to buy. So I appreciate it will have an impact on buyer demand, but I think the greater impact will be on people that already have mortgages and their borrowing capacity, for instance. And so someone that has, already a couple of $1 million of loans, that's going to have a big impact on their cash flow and therefore a big impact or a larger impact on their borrowing capacity as well. So I think it will be positive, when we see those interest rate cuts, I think it will be positive for the market, but of course in isolation, but of course it really depends on what's going on at the time and the sentiment at the time and those sorts of things. I think perhaps of a greater impact, which will impact sentiment, is really what are the expectations beyond 2025. And we need to remind ourselves, and I certainly said this many times during that COVID period when interest rates were, when the cash rate was almost zero, that interest rate expectations can change very quickly, and we saw that happen. And so we need to remind ourselves that whilst we expect interest rates to be cut, it's possible that those cuts will disappear overnight for whatever reason because the data is showing that inflation is persistent. Conversely, it's possible that we start to see some really bad economic data and the money markets might price in a whole heap of more cuts in the future. The thing is that this outlook can change very quickly, and any outlook change is obviously going to have an impact on the property market. Now, before we consider what might happen in 2025, what I'd like to encourage people to do is really focus on the medium-term outlook, the medium to long-term outlook, if you like. I think that is a better way to look at markets because, what happens over the next 12 months is really, frankly, anyone's guess. But picking what happens over the medium term, which may be sort of 3 to 7 years, if you like, I think it's a little bit easier to predict these things, and I think it helps with investment decision making as well. So I've shared a chart in the blog many times before, which illustrates that property grows in two cycles, a flat cycle and a growth cycle. And I've got a link to that chart in the blog on the website, of course, if you want to have a look at that. What I've done this time is taken the analysis a step further and looked at all the growth cycles since 1980 and looked at all the flat cycles since 1980. And what I've done is calculated the average and the median impact of those growth cycles. And of course, there's always going to be a few outliers, but it's relatively consistent when you look at the data. Again, the table of the data is in the blog on the website. It shows me that the average growth cycle lasts about 10 years. Just shy of 10 years. And over that time, property prices triple. So the median house price at the beginning of that 10-year period versus the end of that 10-year period, it's 3 times higher. Now, I think we've got to be careful because sometimes we're looking at growth cycles in, the early 2000s or even in 1980, for example. Of course, the percentage increase there is going to be a lot higher because we're coming off a low base. So I wouldn't be too worried about, what the percentage increase is because, of course, as, prices rise, even a 10% increase on $1 million is 100,000, which would have been a lot more than what would happen in 1980. So I'm not too worried about the percentage increase, although it is a bit of a guide. It's really about the time period, if you like. So if we say, okay, the average growth cycle lasts 10 years, let's look at all the markets then. So Perth, they're only 2 years into a growth cycle and prices have risen about 40% so far. So if we're looking for a 200% increase, which is the average, we're far away from that and certainly only a part way into a 10-year period. Adelaide and Brisbane have both been in their growth cycle for about 5.5 years and prices have risen by about 70%. So maybe we're past the halfway mark if we can't be too exact with these things, but a 70% price increase is well off the 200% that we normally see or we have seen in a growth cycle. So maybe those markets still have some way to run. I think they do. I'm not so sure about Adelaide. I'm less sure about Adelaide just because of its size, but certainly I think Brisbane's got some more steam in it. And Sydney's really hard to read because it looks like they're sort of 4 years into a growth cycle, but prices have only increased 26% over that 4-year period. I'm not sure whether I'd call that a growth cycle. It's somewhere in between. Maybe we just need to see a few more years of growth or price changes before we can decide where Sydney's at. But I think if people looking back and looking at Adelaide and Brisbane, you would go, well, do you want to enter that market? It's kind of a line ball, I think, because you'd say, well, they may be, based on the data, more than halfway through their growth cycle, so maybe you've missed the boat. For the people that are thinking about Perth, I really do have strong conviction that I think that's got many years of growth left. We haven't yet seen a lot of home upgrades yet, and that's what we tend to see at the end of or towards the middle or end of a cycle. It's been mostly driven by investors just because the fundamentals are so sound. So, yeah, that's interesting to sort of look and provide some context around, where markets are currently at. I also studied, of course, the flat cycles, and there's been a bunch of them, of course, since 1980. And on average, flat cycles last 8 to 9 years. And when you look at real reduction in value. So that is the actual growth or over that flat cycle, less inflation. Because of course, if property's growing at less than inflation, you're really behind the eight ball. You look at Melbourne houses, per core logic, lost 3% in value. Well, inflation's at least 3.5%. That means in real terms, you're down 6.5%. Pretty ordinary result. So growth cycles tend to last 8 to 9 years. And in real terms, net of inflation, lose about 1% per annum over that period of time. So a real reduction in property values. So if you look at Melbourne's flat cycle is 8 years into it and has declined after inflation in real terms 2.4%. So a lot more than what the average is. So it's sort of suggesting that 8 years of flat cycle, we must be pretty close to the end, whether that's this year or next, not really sure, but it's quite possible that we'll see a little bit of growth in the Melbourne market to kind of even out that negative return of 2.4% again, which is a lot higher. There's only been one time, Sydney between 1989 and 1996, where prices fell 2.8% in real terms. So again, another 8-year period. So I think that you look at that data, if we're going to say history repeats itself, I'm not suggesting it definitely will, but it's always a good guide. You would say that Melbourne's pretty close to the end of its flat cycle. Okay, so what does all this mean? Well, it sounds like sitting on the fence, but I really think 2025 will just be kind of a repeat of 2024. I think Perth will be the standout market again with the highest percentage growth. I think that market's only just started its growth cycle. I think Adelaide and Brisbane will still have strong years, maybe high single-digit growth. So maybe not as good as Perth, but I still think they'll record some pretty reasonable numbers, still benefiting from stronger interstate migration, which gives us a good idea of what the sentiment is in those markets. And as borrowing capacity will still remain tight for most of the years, I think more people will be directed into that market, particularly as investors. Whether that's a good decision or not, I'll leave that alone. But certainly from a macro perspective, I think that's where the demand will go. And I'm not really sure what Melbourne and Sydney will do. I think it'll be somewhere between -3 and +3, somewhere between really just doing nothing. I don't think we'll see huge price reductions, not unless we see, a deterioration in the employment market. If we do have a real problem there in terms of people in financially stressed situations, I'm not suggesting we don't have an increase there, but an increase to the extent that it impacts the market, then prices could fall. But I don't expect that's going to happen. And so I think we'll probably sort of tread water. At the end of the day, a 3% reduction in housing, in the Melbourne market isn't that big a deal. The stock market can fall 3% in one day. So if it's taken a whole year to see that, I would say that's pretty much nothing. I think they're likely to lag those other markets. The final thought I want to leave you with is, of course, slower markets can often deliver better opportunities. I think in the long run, any high quality investment grade property purchased at any sort of stage of the growth cycle or flat cycle will deliver good quality returns. You just need to hold it for long enough. You hold any property really for 30 or more years, you're going to see the returns. That I'm relatively certain. It's not absolute, but it's very strong. So from that regard, if you take a very, very long-term view, it doesn't matter where you buy, it's really about the quality of the asset. But if you're going to have consideration to where markets are at, well, then you'd have to, I think from this data, conclude that Melbourne looks like the best value, and I've been saying that for some time, and it looks close to the end of its flat cycle. Now, the longest flat cycle lasted 12 years, so we're 8 years into it. So it's possible that Melbourne could be, not doing so well for another 4 years, although we'll have an election in 2 years' time, so I think that's probably unlikely. And you would say, looking at the data, it looks like it's pretty close to the end of its flat cycle. Can never pick these things with absolute accuracy. But I think the other thing to consider is that quite often slower markets present better opportunities, just because there's fewer other buyers to compete with. So you can't build an investment strategy on buying a property below its intrinsic value, because that's often difficult to do, particularly for a high quality asset. But I know 10% of the time the luck can move in your direction. So it is possible to buy a really good quality asset below intrinsic value, but that's impossible to do in a very buoyant market just because of that buyer demand. So I wouldn't premise my investment strategy on buying a bargain, but I'd just say it's easier to do in a market like Melbourne than, say, a market like Brisbane and certainly Perth, for instance. So something just to think about, depending on what other assets you have, of course. So a bit of a longer episode today. I hope that is enjoyable sort of information. It was really good to look at the, historic growth and flat cycles. I'd encourage you to go and have a look at those tables on the blog and the website, because I think just looking at it visually, I think it's a lot easier to digest that information than explaining it verbally. It's always difficult to talk about tables and charts in a podcast scenario. But that's my view. Of course, anything could happen, but that's the evidence-based view. If you're looking to get into a property market, I'd be really focusing on what do I think is going to happen over the next 10 years plus, rather than the next year. If you're looking to sell property, of course, selling in any of those buoyant markets is a good idea. And when it comes to selling in Melbourne and Sydney, it's going to really depend on the type of property you have and how strong of an asset it is. But of course, you should get some professional advice from a great buyer's agent in that regard. Bit of a longer episode today, so I won't answer any listener questions. And until next week, bye for now.